Okay, so you can't go anywhere these days without hearing about private credit. It's a massive multi-trillion-dollar market. And, while most investors are zeroed in on the quality of the loans, which makes sense, the real risk, the one that's quietly emerging, is actually hiding in plain sight. And this quote right here, it just nails it. It gets to the heart of the matter. We're not just in a different market cycle, we're in a completely different regime. A huge structural shift is underway, and it changes everything about how we need to look at risk. It's not just about asking, can this company pay back its loan anymore? So what is the real risk then? Well, that's what we're going to dig into. In this explainer, we're going to peel back the layers and really uncover those less obvious dangers that are lurking just beneath the surface of this super popular asset class. To really get a handle on the new risks, we first have to go back and understand the old story. You see, for years, private credit had this reputation for being incredibly stable, almost boring, and honestly, for a very good reason. The original design was actually beautiful in its simplicity. You had these multi-year loans, right? And they were being funded by big institutions, pension funds, endowments that were putting up long-term, locked-up capital. The secret sauce was that the timeline of the assets, the loans, and the timeline of the liabilities, the investors' money, were perfectly matched up. That alignment was the bedrock of its entire reputation for being safe and predictable. But here's the thing. That very foundation, it's cracking. And this is creating a new, and I think widely misunderstood, structural risk that has almost nothing to do with whether the loans themselves are any good. And I mean, just look at the difference here. The old way, long-term, locked-up capital from patient investors. The new design, we're talking semi-liquid funds that offer people the chance to pull their money out periodically. This brings in a totally new kind of investor, one who's way more likely to react to headlines. And boom, suddenly your expectations are completely out of whack. This creates a classic textbook liquidity mismatch. And I love this analogy for it. It's like hooking up an ATM to a 30-year mortgage. It doesn't work. You can't expect to get your money out on demand if that same money is tied up in an asset that takes decades to mature. And here's what makes it so incredibly dangerous. This risk is a ghost. It's completely invisible when markets are calm and everything's going up. It only rears its head when things get choppy, when investor confidence starts to fray, even if the loans themselves are fundamentally still fine. Now, this whole problem is basically getting supercharged by a massive shift in who is investing in private credit. We're talking about a real changing of the guard. Just think about the two types of investors. On one hand, you have the institutions. They operate on these long-term, data-driven models. Their money is stable, it's predictable. But on the other hand, you have retail investors, and they're, naturally going to be more reactive to news, to sentiment, to what they're hearing online. This introduces a whole new kind of volatility, a volatility that's driven purely by the story being told. And that brings us to this powerful concept called reflexive dynamics. It's a dangerous feedback loop where perception literally creates a new reality. A few bad headlines, they don't even have to be true, can be enough to trigger a wave of people asking for their money back. And that can push a perfectly healthy fund into a life or death crisis. And this is where it all stops feeling like finance and starts feeling a lot more like psychology. The whole thing transforms into a confidence game. The dynamics start to look an awful lot like a classic bank run. Now, funds do have a safety valve. It's called gating. It lets them slow down or even pause withdrawals to stop them from having to sell off all their assets at fire sale prices. Think of it like a fire door in a crowded theater. It's a totally rational safety measure, right? But what's the first thing you think when you see that fire door suddenly slam shut? You panic. Gating is a total double-edged sword. And that one action can set off this really nasty chain reaction, what we call a signaling cascade. So step 1, a fund gates redemptions. Step 2, that simple act screams potential stress to the entire market. Step 3, confidence across the whole sector just tanks. And before you know it, step 4, redemption pressures start building on all the other similar funds, turning one fund's problem into a potential system-wide crisis. Which brings us to this incredibly powerful idea. In these new structures, investor confidence isn't some fuzzy, abstract thing. It literally functions as a balance sheet variable. It's as real, as tangible, and as important as the loans and the cash themselves. So if the old-school metrics like default rates can be misleading, how are we supposed to spot trouble before it's too late? Well, we need new tools. We need a way to see in the dark. A fantastic way to think about this is to compare the VIX, the volatility index, with a different concept called turbulence. Okay, imagine you're flying a plane. VIX, or volatility, that just tells you how bumpy the ride is. But turbulence, with a capital T, that tells you something way more important. It answers the question, are the controls still working? It actually measures when the normal relationships, the correlations between different things, start to break down. And that is exactly why turbulence matters so much more in this new world. It's an early warning system. It's the smoke detector. Liquidity problems often show up as a breakdown in these correlations long before you ever see a loan actually go bad on the books. It spots the stress before it becomes a full-blown crisis. All right, let's bring this all home and make it practical. We have to move beyond just looking at the yield a fund is promising and start asking a completely different set of questions. This is your new playbook. So the new playbook means you have to stress test the fund's structure. You got to ask, how does this fund actually hold up when people keep asking for their money back day after day? What's the real mix of retail versus institutional money in there? If things go bad, how do they get cash and what does it cost them? And maybe most importantly, what are their specific tripwires? And what is the exact plan the moment one of those alarms starts flashing? So I want to leave you with this. The attractive yield, that's what everybody sees. It's on the front page of the brochure. It's easy to compare. But the hidden structure, the liquidity design, the investor base, the governance plan, that's what you actually get. And in this new era of private credit, that hidden structure might be the only thing that really matters.